Thanks for joining us tonight. My name is Aaron Fregnito. I'm the People's Capital Group. We have Keith Blackboard here as well. How you doing tonight, Keith?
Good to see you, Aaron.
Absolutely. Thank you, my friend. And yeah, so we're glad everyone's jumping on here. We're going to talk tonight about, are apartment buildings still a good investment? I focus on buying apartment buildings. I help people invest in apartment buildings. We pull capital together. We have an in-house management company here, People's Capital Group, and we've been doing this about 10 years. So I'm a big apartment building guy here. This is what I focus on. I've been investing in real estate for years, and apartment building specifically, although I've done mixed use, different types of fix and flips and so on. But I will be arguing for apartment buildings ideally, and Keith is going to be opening up to all different types of real estate as well, and wealth opportunities. So Keith, you want to give yourself a quick introduction there?
Sure. Actually, I want to talk about you first. I met you. You came out to my San Diego event back, I don't know, 2.5 years ago, the first one I ever did. And we got to hang out and meet with a bunch of other people. You were nice enough to host me on your podcast after that. And so it was just interesting. It's been fun to watch you grow as you expand out in New Jersey and do property management and some other things. So I'm glad. Thank you for having me back. I help business owners reach work optional in 3 to 5 years. So once you already have that successful portfolio or some assets, how do you transform it and optimize it and make it something that can get you to work optional much faster?
Mm-hmm. Great, awesome. Yeah, I really enjoyed, Keith, going out to San Diego with you and doing that those workshops out there that you taught. That was really incredible. It was so much information, and the people I met as well. I'm still in touch with them. They follow me also. So really great connections and really good experience. So if you have the chance and you're invited to one of Keith's event, definitely check it out. They're very cool.
Perfect. Well, I want to just start off by asking you about the market. You cool with that?
Yep, sure. So go ahead and you can start asking me the round of questions here, and I'll do my best to answer.
So with rising interest rates, slow market demand, do you think apartments are still a good investment? Why, or where are you seeing the market going?
Sure. So here's one of the reasons we continue to buy apartment buildings today, even as the market cycles kind of from a seller's market to a buyer's market. We focus on buying a value add apartment buildings. So that means apartment buildings that are mismanaged, rents are below market value. There's opportunities to make more forms of income on the property, maybe through parking or storage or laundry. And there's also ways to increase the rent, renegotiate current leases, also essentially renovate the property throughout, and allow us to increase the revenue, the net operating income of the building. So there's very clear value add. There's a very specific amount of rent we can increase the property by, in total amount we can increase the rent roll. We're not creating pie in the sky opportunities. Maybe we can get this, maybe we can get that. Generally the building is already shown it can get that amount for renovated units. So when we go to purchase a property, we aren't, hoping the rent goes up over time or just sitting and waiting. There's a very clear value add, very heavy lift of renovations, improved management. That's why we developed an in-house management company, just to do that exact purpose. And I was going
to say, building off of that, how do you price in cap rates into your model as part of that, especially if they're going up?
Yeah, well, cap rates right now, we're underwriting a building in Bayonne just today, and we're saying, okay, well, Bayonne, 6 months ago was at a very different cap rate. So we increased it by about 4 tenths, it's about 40 basis points there. So we, depending on the market, what's going on with it, of course, there's all different indicators. We're increasing cap rates right now. And now our brokers are saying
for the sale as estimate too.
Yeah, exactly. So down the road, we're assuming the cap rates are higher. Right now, as far as calculating our purchase price, we're going a higher cap rate, lower offer amount. Yep, absolutely. You got to buy smart right now, right? You want to look at your cost of capital as well, the cost of the mortgage or the interest rates where they're at. That's going to be about a whole point higher at least than where they are really almost 2 points sometimes, depending on the broker and the type of mortgage. So we're offering more conservatively. We have a conservative outlook as well. We assume inflation goes to about 1 to 2% in the long term. We assume it just stop, rent kind of grows stagnant for some time and then starts to pick up again. Yeah.
Inflation goes to 1 or 2% in the long term?
1 to 2%. Yeah. Mm-hmm. Exactly. So just for conservative assumptions, painting a market picture that's recession essentially for some time. But recessions don't last forever. So if you paint a picture of a 20-year recession, you'll never buy a property because your offers are going to be way too low. So you want somewhat of a realistic prediction, but that's the hardest part of my job, right? Predicting the future. Of course, no one can do that. So all we can do is try our best to say, hey, we know for a fact we can increase the value of this property by 25 or 30% if rent stops growing today. We also know that inflation and a bunch of other measures, like the huge demand for real estate here in North Jersey and the lack of housing, all these upward pressures, the cost of buying a home right now is more expensive than renting. So renting tends to be a pretty popular option right now in a recession. So, we weigh all these options and say, okay, well, rent is likely to keep growing a little bit, but we're going to assume it stops growing. We can still improve the value by 30%. So, buy smart, buy with value add. And that's
so how do rising interest rates then affect your business, especially if they go as high as they were in the 80s or just anything in that range? How does that affect your business or your buying plans for the future?
Sure. So whenever we're purchasing a property, interest rate is just a number in the spreadsheet. There's hundreds of inputs we're putting into that spreadsheet. So your interest rate is just one of them. And quite frankly, the higher the interest rate, the less money you can borrow, less capital you can borrow, right? So you're going to get a lower mortgage amount, therefore increasing your down payment, therefore possibly decreasing your return on investment. So at the end of the day, you're just going to lower your offer amount so that your numbers make sense. And so the higher cost of capital is going to lower the offer amount. Now, as a buyer, that might mean you don't get the deal right away, but I think the market is turning in our direction as a buyer.
Cool. Awesome. I appreciate that insight.
Yeah, absolutely. Now, if rates go up to 18%, right, then, okay, well, then we're going to start to have to get creative at that point. Now, I don't think that's a sustainable number either. That it was also, during the 80s, I don't think we're going to run into that. But in that scenario, yeah, absolutely. Like that's not a great time to buy, right? So you're going to look into seller financing, maybe check out different funding options from private investors. Really what we would do in that case is most likely go to our investor pool and say, hey, we're going to raise 100% of the capital to buy this property. We're going to do our 3 or 4 year project of renovation and repositioning the property. And by that time, we do assume interest rates are going to be at a more reasonable level. So we can ideally refinance at that time and have a nice big liquidity event for the investors and ideally get back the majority of their capital right there. So, that's ideally the strategy. That's how it would change in a crazy high interest rate environment.
I want to just weigh in and I like that you're mentioning that, in that I've thought when interest rates go up, almost nobody can buy. And ideally, we know when you can do debt leverage, that means less of your own cash in the deal, higher returns for investors. But the flip side of that, if very few people are able to buy, we're all buying on the same terms. So you buy at the higher price. And as you said, interest rates are likely to come down at some point in the future. And so then you're able to cash out at that point. So you're able to pick up a bunch of properties when hopefully fewer people are buying. And then really part of your sales model is doing a refinance 2 to 5 years down the road, getting your money back out. And now you've got a much higher NOI than other people. So you can hold for cash flow or sell at that point if it makes sense.
Yeah, I mean, if interest rates were where they were in the early 80s, around the high teens, the buying opportunities would ideally be phenomenal, right? Cash would be king. Really, cash is always king, but definitely in that environment. So that's one of the reasons we started a fund on August 1st, because cash is going to be king really soon. In fact, I think it already is.
Awesome. Thank you for that. Yeah, that's cool. So do you think you should wait to buy real estate since the market is in a slowdown, or how does a recession affect your future buying opportunities?
Yeah, so that's a good question. And it really depends on the deal, right? We always look at properties on a deal by deal basis. I'm never a fan of trying to time the market. For example, I tried to time the market with cryptocurrency. I lost 80% of my investment. So that was me timing the market, right? I nailed it. So that timing the market's really hard. The best way to invest is to invest consistently and wisely in assets that have clear value add, ways you can improve the value of them, whether the market's up or down. So, with apartment buildings, again, the value add, it's all about that. we really have to recognize that we're likely entering a buyer's market, but right now the economy, the market acts so weird. We really don't know. You can listen to all these talking heads on CNBC and whatever for hours, but they really don't know at the end of the day. And a lot of times these predictions from these experts are completely wrong. So I really always have my buyer's hat on. And, that might mean that there's times where maybe you're, not buying in the best market or getting, absolute lowest price you could have ever got. But in the long run, I look at these deals I've bought, back in 2012 or 2013 near Rutgers University and areas like that, downtown Newark, and I'm thinking, boy, I'm really happy I didn't kill the deal over like $5,000 or something, because I bought properties back then for $135,000, which if the guy countered me at like 145, I probably would have been like, no way. Now that property is appraising around $700,000, and I've probably put maybe $50,000 to $80,000 into it through the years and just collected cash flow on it. So you buy in the right areas, you maintain the real estate the right way, just wait. And it really accelerates. It's incredible what, high demand markets with huge populations like North Jersey, where you can go with the right equity plays. Now, so that was a little bit of timing the market, but more it was timing your location, right? It's actually easier to, work your location than your timing. So right? You can control your location. You can't control your timing as much. Right?
And you've been talking a lot about value add. When you say value add, are we still talking strong renovations, or what do you mean by that?
Sure. So we like the value add that you're putting some paint on the walls, redoing the cabinets, refinishing the floors, fresh vanities throughout, giving it an overall cosmetic and upgrade, improving the finishing, sometimes putting in granite countertops, new sinks. Other units, we're going to do subway tiles, put tiling in the bathroom, things like that, backsplash, right? So that's value add right there, improving the common areas. One building we're looking at, a 63 unit, has a gym that has filled with drywall and construction material, the cellar's holding there, where we could, turn that back into a gym pretty easily. And that's an obvious value add. It has two locker rooms, 4 saunas. It's being used to hold drywall. So that's, an obvious value add for the building. So part of value add is finding those deals that have obvious, clear value add. A gym being used to hold construction material is an obvious thing we could pick. So in that case, but there's also, you can add a level, right? You can take an office building that office is no longer demand, change it into an apartment complex, highest and best use. That's much more complex. See, we don't do that. The more complicated you make the deal, the more hammers you're moving and framing and everything, permits you're getting, architectural drawings, the more risk you have.
Sure.
The more blockades you're going to run into. So in my experience, after doing 50 fix and flips and dealing with bureaucrats and architects and permitting, you want to try to avoid that, really.
So when you say value add, sometimes I'm almost a little surprised that some of that still exists. Not in your market. I know you're out in New Jersey. You do some smaller projects where I think some stuff may have been overlooked. I feel like in the Dallas, Texas area, I feel like just about everything that could be upgraded has been upgraded, at least the 100 unit plus property. So there's less value add opportunities. And so the opportunities are fewer, and there's a lot of people competing. So it sounds like there's still opportunity for you to out there.
Oh, absolutely. I mean, we consistently do marketing, everything from billboards to mailers to online marketing, because if you're not marketing to find new deals, then, half of our value is as syndicators. The reason people invest in us is because we find great deals. Yeah. And sometimes that is through a broker. In fact, more often than not, we do find it through a broker, but you can have very good relationships with brokers and get pocket listings, which is extremely valuable. So that's why we focus on this market in Jersey. We've been doing it 10 years. We know the landlords. We try to recycle those relationships. So they sell us multiple buildings over time with off-market deals. We know the realtors. They're going to be, get the both ends of the commission if they come to us. We're going to be easy to do business with if we can get the right price. And so, wholesalers as well. And that's why we stick to this market. People say, why don't you go to Texas? Why don't you go to Georgia, South Carolina? Look, it's on TV. Everyone's investing there. It's the best market. Well, actually, the best market is the one you have the resources and the infrastructure in, where you can crush it and you have that competitive edge. Sure. That's the best market for us. And that is North Jersey. It also happens to be one of the highest demand markets in the world, which is very good for our investors.
And then also in line, there's a question in the chat that I liked. I think this was Todd that asked, before you refinance, do you prefer today, are you doing fixed or floating rates? What kind of, how do you manage interest rate risk is really what that's asking.
Yep. So we're looking at fixed rates generally for 10 years right now. Sometimes we try to get a Fannie Mae, Freddie Mac product. It really depends on the property. We're also looking at some situations where you'll have a bridge loan. That's a little scary right now because that'll be floating for about 12 to 18 months. So we don't really like that. We're sticking with the 5 to 10 year fixed rates right now.
Okay, cool.
Yeah, absolutely.
So, and the new fund you mentioned in August, is that a blind pool, or do you already know the specific asset that's for?
Sure. So we actually do have a property we are purchasing with that fund. We're working on our due diligence right now and finalizing the contract with the sellers. So that's a 63 unit in Trenton, New Jersey. And yeah, so we opened up that fund on August 1st, and it's going quite well. It was, boy, a busy day. About a lot of investors had about 3 more investors come in just today. So yeah, definitely a lot going on there. And we actually have a couple other buildings we're looking at as well, in case that we don't close on that one. So it's not a blind fund. We do we take a property, we analyze it, we bring it to our investors, we say this is the property we're going to purchase. If they don't want to purchase that property, they can exit the fund. But so it's not a blind fund.
Okay, cool.
Yeah, absolutely. So yep, very exciting what we're doing right now. And no, I mean, it's you know, you have to buy the properties for value add. So you got to be smart. We're doing right. We're trying to lock in the best types of deals. And right now you got to be picky too, right? If we don't get the right numbers on this deal, or whatever reason we find a red flag, you have to be able to walk away from a deal. You have to set up your purchase contracts so you do have some flexibility in there as well, which was very frustrating in the seller's market, because they'd be like, you know, you have 3 days for due diligence or something, or 0 often, which is very, very hard. So yeah, I'm welcoming this new buyer's market. I think we have to have some equilibrium between the buyers and the sellers, because the sellers have had their way for far too long now. And it's shown in the prices, the terms of contracts, you know, mortgage contingencies are non-existent in commercial contracts these days.
So you're seeing that shifting, and I've known a few people that have done some retrades, meaning that they settled on a price, banker said, nope, sorry, that's too high. The interest rates can't justify that price. So they're having to go back to the seller, and the sellers are often coming down in price. What are you seeing there?
Yeah, I mean, that's exactly what we're pushing for. Now, not all sellers, you know, have gotten the memo yet, and some of them are still, there's still a lot of eager buyers out there. In fact, the market in a lot of areas that we buy, like Newark, Patterson, Jersey City, Bayonne, we're purchasing a property now. We're looking to purchase a property. So those markets are still really hot. They're just not cooling. The demand for housing in North Jersey, just outside of Manhattan, has just accelerated, you know, tenfold with the whole pandemic and everything. And then West Jersey, it kind of just falls as wave outward. And they just can't build them fast enough. You know, getting permitting, get everything built in here in New Jersey, it's a blue state, it's a tough state to develop in. And most towns, especially in West Jersey, you kind of get out more of the open suburbs, they like their 1-2 acre lots. And there's no way that town's going to vote out, you know, minimum 1 acre, right? So now, or even any new development, no matter what, like Clinton, New Jersey, for example, will not allow new development. Last 25 years, it's not going to happen. Wow. Right. Period. End of story. So, you know, obviously there's cities like Newark, Jersey City, Patterson. These are super aggressive on allowing development. That's very good. There's a ton of units coming to market. Right. But I think also there's a lack of single family homes, but you know, who knows? We just need more housing in general. So I think eventually we'll reach that equilibrium, but boy, it hasn't happened here really in North Jersey yet. Yeah. So seller's market. Yeah.
So clearly you've got a niche in apartments, multifamily housing. You've done well with that. Have you considered investing in other types of real estate? Why or why not?
You know, if it ain't broke, don't fix it, right? We're very good at taking mismanaged apartment buildings and making them perform with our in-house management company. We have a staff that's specialized in that. I've hired and fired 4 different management companies, property management companies, and none of them were exactly specialized in the art of repositioning mismanaged apartment buildings. You know, so the building we're looking at in Trenton right now is a 63 unit in foreclosure. And it's a pretty big mess. There's evictions going on, there's non-paying tenants. Who the heck really knows once you get in there, right? That's just what the seller's telling us. So, you do your trailing 12-month collections when you're doing your due diligence in these properties. And it comes down to, wow, like this guy wasn't collecting nearly what he said he was, right? And so that's the situation now. So that's would cause for a retrade, in our opinion, meaning renegotiating the price lower. But then again, a lot of times the seller's like, listen, buddy, you're getting a mismanaged property right now, and I already worked that into the price. So that's obviously part of negotiating, going back and forth. But yeah, it's a very specific challenge to take those mismanaged tenants and buildings and figure out how to work every way of profit out of the building so we can meet our investors' goals, but also respect the tenants too, follow the laws. There's rent control laws, right? There's red tape you have to navigate. We go with our best foot forward, a nice welcome package. Hey, before you probably had a not such a great landlord or property manager. Now we're here to fix that leaky dishwasher, take care of your issues. Here's what you do when there's a service call. Here's how you can pay rent in 3 different ways, right online. But by the way, with all this improved management and the common area and the amenities we're creating, there's going to be an increase in rent. And often people are actually very open to that. And they say, finally, so you're going to fix my leaky dishwasher, bring the gym back to life, and my rent's going to go, all right, fine. It's a good trade-off. If they're not open to that, then, we'll try to work on an amicable exit.
That's interesting. You have to be much nicer to the tenants than we do here in Texas. If somebody doesn't like the terms, we so not so politely just ask them to move on. I'd like to think that a lot of people treat their tenants nicely, but the rules are just structured very differently here in Texas, where they're very in favor of the landlord, which is, it's a good place to be the landlord. And where you're talking about, you mentioned starting your own property management company. I see a theme with a lot of syndicators, people that get in that have been in it for 5+ years. They realize that the management piece is hard, and having somewhat third-party property management, usually there's a life cycle there where they usually go through so many cycles, and then they've got some issues, and it makes more sense for them to start their own property management company.
Mm-hmm. Yeah, around 50 units, we started to recognize if we're going to borrow other people's capital, or not borrow, but put other people's capital to work and invest it in real estate, and we're going to hire a third-party company to essentially run the entire project. It's like, pulling capital, putting into a business and just be like, all right, you run it. So yeah. It really makes sense to have an in-house property management company. It gives that added level of security and control of the asset. It's very different when someone's not doing their job and they work for you, and you can either fire them, or you can talk to them and put them on probation, some type of scenario where you can get results. If it's a third-party company, they can lie to you. I had a management company steal money from us. They met tenants of the property. They would lease it out to tenants. They would sign a lease and say, okay, you can move in a few days, and meet another group of tenants there that afternoon, collect the cash, and do the same thing. They leased out the unit to 3 or 4 people, ran off the money. I'd taken a small claims court, so we dealt with a lot of challenges, and we said, holy mackerel, if we're going to work with other people's capital and entrust an entire third-party management company, that's a sketchy business model. Now, I get it. Most real estate syndications do that, and they have huge success with it, and that's great. And that gives you the ability to invest in multiple markets, and there's benefits to that. However, we just have a different model, a different look at it. I don't really trust other management companies. I trust my staff because I know how good they are. I know how hard we work to train them, and I also see the money. I know where the money is, so I have access to the accounts.
So there's another question in the chat asking about how you're finding properties. Are you cold calling, relationships? Any advice for people just getting into multifamily? How would you get started?
Boy, how did I get started in multifamily? So I actually started as a realtor, and we would put signs on telephone poles that say, we buy houses. They used to work really well. We bought a 6-family together, my business partner, Seth Martinez, and I. He had sold a medical billing company, so he had cash. I had the deals. I was a realtor. And so we teamed up, started doing properties together, buy, renovate, refinance. Then I started going to real estate investment groups, RIAs, real estate investment clubs. I went on meetup.com and found them there. And I made a beeline for the owners of those RIAs. And I said, hey, I'm a realtor. I'm new to the market. I've done 14 short sales, and I bought a 6-family, and I'm working on renovating it. Can I speak at your RIA about all the things I'm doing? And they're like, sure. So we need speakers, because people that run RIAs need speakers. I run a RIA, I know. So, I went up to them and they said, yeah, you can speak next month. So I spoke and retained a couple investors from that speaking engagement. My topic was fake it till you make it, which was incredible because I was literally kind of faking it till I made it at that time. It was like, it's about 10 years ago. So that's how I met my first investors. And today they actually, some of them still invest with me, and we had great experiences as well. So, and I still, the majority of my relationships with private investors actually comes from our RIA. We have about 4,000 members in it now. I developed my own RIA eventually. So that's been a blessing. Mm-hmm.
So how are you finding property in today's market then?
How do we find property? Well, brokers, pocket listings, we treat our brokers just like we would treat our investors or our tenants or anyone we do business with. Our best foot forward, take them out to lunch, keep that relationship going, try to meet up maybe once a year in person, something like that.
Do you give them equity in the property or allow them to buy in? How's that?
Bro,
No.
bro, you'll give your broker equity. Jeez, Keith, come on. You never, broker equity. Brokers don't get equity. Sorry. No, your broker could, of course, get equity if they invest in the opportunity, but they can't do that if they're a listing agent. Sorry, I yelled at you. Everyone's asking for equity, Boy, oh boy, sorry. I had a conversation with a co-fundraiser today. He's like, yeah, I need 15% of ownership of the building. I'm like, if you bring in what, $250,000, is a crazy conversation. So incredible what people ask for. Yeah.
Yeah. Well, you're not going to get it if you don't ask.
That's right. Closed mouth doesn't get fed. No, your brokers are going to earn a commission. They're going to do very well. My brokers, they do extremely well. They make hundreds of thousands of dollars off me, and I'm happy for them. But I don't negotiate their commission, and they're usually negotiating against me. But that's kind of what a broker does.
Okay, fair enough. Fair enough. Cool.
All right, great. Is there any more questions here on the chat, or do you want me to do your questions now?
You're welcome to ask away. I was just more seeing if there's anybody else on the line who had other questions. Yeah, I know a lot of the people already. So,
here's one more. Looks like do you have a philosophy regarding leverage? In other words, do you juice LP returns by adding preferred equity or junior debt, or do you stick with conservative LTV in this uncertain environment to protect investors against a potential devaluation during your holding period? Keith, you have some very well-educated, smart people in your group. I must say these are great questions. I really enjoy them.
I try.
Absolutely. So, we don't juice the LP. That's an interesting term, juice the LP. So no, we don't do that. That'd be a good podcast episode. Maybe I'll make that one day. Preferred equity or junior debt. So preferred equity is when you have essentially, it could be a group of investors or a hedge fund or just a private investor that's kind of aggressive, and they're going to want maybe a 10, 12, 15% preferred rate of return, but they want to get paid first before any other shareholder, including the other LPs. So that's preferred equity for anyone that doesn't know. And junior debt would be ideally, I think what they mean by that is like mezzanine debt, type of bridge loan, like secondary financing for construction or something like that. So it depends on the deal. If it's a very heavy value add, there are times we'll do a junior debt or mezzanine financing or a bridge loan. I don't do preferred equity. That's more for ground up development where there's a lot of profit, a lot of meat on the bone, because preferred equity is so expensive. I also think it's not really a great deal for the LPs or the GP. Preferred equity is kind of dangerous. There's some very fine print in there. They're often very savvy hedge funds or family offices. Like, if you don't get me paid back in 18 months, my equity doubles or something. So you got to be careful with that preferred equity and what you're getting into there. But junior debt and mezzanine financing can definitely be a great option. So can preferred equity. Absolutely. So I don't really focus on those strategies with our purchases. We generally raise the CapEx, the renovation funds. We generally raise the funds for the closing costs and other reserves and things like that as well. Okay. All right. So, Keith, let's cut into your questions here. Okay. We'll start off with number one. All right. What are your favorite types of investment for today's market?
I like things that cash flow and have equity in that. So some of you guys that have been with me, I'm going to sound like a broken record, but examples of that: dividend paying stocks. It could be apartments. They have equity and cash flow. Businesses with strong IP. I'm seeing opportunities to maybe buy in to things that are a little diversified outside of what you normally do. So some of you guys currently with me have seen Reserve Entertainment, the movie fund. We had the hardware capital group come on that's leasing out tech hardware, stuff that there's real intrinsic value in that, and then getting cash flow on top of that. So cash flow itself is a hedge against inflation, gives you an immediate return as long as it's positively cash flowing. Whoever is in control of it doesn't have to sell. You're not going to go bankrupt. And equity growth provides a hedge against inflation, which is why real estate or other large hard assets like that are a great hedge for inflation. So even if you think multifamily appreciation might be stymied by rising interest rates, there's an intrinsic value in the property or the real estate itself, which is why I continue to own that as a core part of my portfolio.
Wow, very nice, very nice. Okay, excellent stuff. So wow, the movie industry, huh? That's a new market for you, it sounds like, right?
I like a variety of non-correlated assets. And so I started making money in apartments as my core asset, but as those are paying off, if I invest 100 and somebody gives me back 200,000, then I'm taking 100, putting it back into real estate, and taking another 100 and putting it into something else. And I also like to be diversified across multiple great syndicators, because a lot of my stuff is concentrated in Texas, because that's where I got my start. I'm down in Dallas. I like to be in other markets because, I don't know, if Houston floods or there's some issue, I like to be geographically diversified as well as part of that.
Got it. Cool. Very nice. Very nice. All right. Number 2, what are the most useful tax strategies for apartments in this market?
Okay. Everybody have 4 hours. Let's go.
Oh my gosh.
Now,
it's like the seminar in San Diego.
No,
8 hours, that was a tough one.
No, we just did a tax strategy workshop, and I think it was valuable for people, or at least that's what I'd like to pretend to believe. So all that said, I think with real estate, this almost the same tax strategies can apply in any market. There's a few key things. One, Joe's on this call, so I'm going to say this sheepishly. We're working through, I like discounted rollovers. So this is where you're able to invest in a traditional account, and at a future point, when you have a deal with a predicted drop in value, then you do the rollover. So Aaron, I'm going to put you on the spot. Do you have any projects coming up where you know the NOI is going to drop maybe 3 to 6 months in due to a major rehab or something like that, as you kick out non-performing tenants or do a significant rehab?
Well, sure. Usually the first 2 to 3 years we own the property, we on our pro forma, the first 2 years we say there's no cash flow, although we generally do produce some. But yeah, now it can drop. It can just, start a little bit and then stop, or it can kind of trickle and then grow into a nice stream. But it's hard to predict that part of when you're moving out.
So that's the part. I'm working on something right now that's a possibility, and that's the struggle we're working through right now. And it might still work, but I'm looking for several opportunities so people have options. I would, like, you buy day one, I want something where the NOI is going to drop. As you know, apartment complexes are valued based on the NOI. So I invest $100,000 with you. Let's say you take the occupancy from 80% to 60% as part of the rehab, kicking people out. So the NOI temporarily drops in half month 3. We get an evaluation done of their property. We do a rollover the asset, not the cash, from your traditional account to a Roth account. And I pay taxes on the $50,000 valuation at that time. But since I invested in you, it's going to now rise in value to $200,000 in 5 years, all within my Roth account.
Okay. I like it. Very sophisticated. Well, we are IRA friendly, so your IRA custodian should approve the documents.
Yeah. Well, I'd love to know if you happen to have, or when next time you're looking at your NOIs, if you have anything on a monthly basis that has that kind of an NOI drop. I've got a whole bunch of people that would be interested. Yeah,
the problem is it's a little too hard to predict that. It's not it's also consistent, right? Because we're not sure how many tenants are going to cooperate with a move out, how many tenants are even paying rent sometimes, or going to
Yeah.
cooperate with the new management. And then you also have market headwinds and just so many variables we don't control. We buy buildings a lot of times. The tenants are like, well, the last landlord let me skip a month, right? So like that guy's not really going to work out, so it's
okay.
hard to predict.
That's fair.
Yeah.
Yeah, there's certain scenarios that make it really good sense. But yeah, I know that that's been part of what we've been running into.
Yeah. Well, if you want me to, I'll look into it. I can get back to you on that. I mean, for the most part, yeah,
Sure.
it goes up and it goes down, but once we get going on it though, it tends to grow there. Once you start creating cash flow, it kind of snowballs. Yeah. So it wouldn't really be up and down.
So here's a scenario where it did work, where I did last summer. I invested in something that was an apartment complex that was Disney's college for their performers down in Orlando. And so for the first 3 years of the project, it's on a triple net lease with Disney. The moment the triple net lease ends, it goes completely vacant. And there's a large lease up of, I think it's like 600 units that happens immediately after that at much higher rents.
That's interesting. Wow. That's a cool opportunity. Do you get free passes to Disney World if you invest in an opportunity?
You know what? I wish. I tried to go meet the performers, but the princesses all wanted to stay away.
That's too bad. It's tough, Keith. I mean, that tax talk, I don't know, must get those princesses going, but I guess not, huh? It's too bad. All right, we'll go on to our next question here. What are some lucrative investment opportunities in today's market?
So frankly, today's market, I like to think of stuff creative. You touched on some of it with like asset conversions, hotels to apartment complexes, or office spaces to apartment complexes. A little higher risk. There are permits. There's developing tertiary retail markets to self-storage. Anything where you're changing use of the property from something that's less functional to something that's much more functional. In general, I like hard assets with low fixed interest rate debt. So I don't want to really be buying or investing in real estate right now that has a variable interest rate. There's got to be an extremely good case, but as interest rates, I think, are likely going to be on the rise, I want a low fixed interest rate, and I can always hopefully refinance later to something lower if and when a recession changes and we go back to lower interest rates, if that ever happens, hopefully. I also see self-storage, high-end RV parks as kind of like some opportunities in the market that are a little less tapped. Self-storage is also becoming a little well-known. So maybe the high-end RV parks, in recognition of all the people that bought RVs over COVID. Rehabbing oil and gas wells. So I've got a guy coming on to my community. I think it's next 2 weeks from now. And that's what he does in the Dallas market. Is there's almost nobody touching oil and gas. A bunch of operators got out of the market or went bankrupt due to Saudi Arabia driving oil prices down in 2019 to make the operators go bankrupt. And so it's essentially the same concept with multifamily, but oil and gas. You're buying these oil and gas wells that have fallen behind on maintenance. Production has gone down. And so if you can get in there, do the needed maintenance, rev up production, you can often double or triple the production of what it was. And that's a significant moneymaker. And then lastly, just buying a business and installing a team. So it's really still passive. So that's part of what we're talking about at our Orlando event this November. By the way, if you want to come, it'd be great to see you again. So there's a lot of baby boomers getting out of the market. A lot of them are just shutting down their businesses. So you can often acquire these businesses for not a lot of money, or there's people that specialize in operations of these businesses, almost like a management company. I know how much you love management companies. So you can find and pair the right business management company with the right business. Then your business could be a matter of buying and scaling these kinds of projects.
Now, how do you, sub question here, so how do you find good businesses to purchase?
That'll be a great topic for Atlanta. No, so there's all sorts of just
Give me a
similar to
teaser.
real
Give me a
estate.
teaser. Yeah. Mhm.
There are brokers, there are listings. You can do stuff the conventional way,
Uh-huh.
but you can also do direct mailers. That might sound weird, but you can actually profile business owners based on age. You assume people 55 to 70 are
Right.
likely to want to sell at some point soon.
Mhm.
And direct mail marketing, you can take some of the concepts that you learned from single family and real estate. That's why I think starting off in single family real estate is a great way to become scrappy and learn all these skills, and then go apply it in other ways that they're not used to doing it. So you can do direct mail marketing, you can do a business website, but
Yep.
most business owners have probably never thought that their business is worth anything. So you could target a specific niche of business and directly contact them and skip the brokers who are going to try and charge 10-ish% to and increase the price
Yeah. Right.
by doing it. Yeah.
Yeah. Generally increase it by their commission amount. Yeah. Okay. No, that's great. That's great. So not so far off from how you buy a mismanaged apartment building in a sense. Yeah. I mean, we
Yeah.
kind of target the same
Yeah.
demographic. Yep. Older individuals looking to, sell their holdings at a certain age in life. Absolutely. And they tend to kind of get to a point where they're tired of managing it and it's kind of fallen by the wayside and brings the price down. So that's maybe a good time to buy for the buyer as well. Yeah.
And then I had somebody else private message me a question for you, asking what is your deal structure you offer in investors?
Sure. So we opened PCG Fund 1, and that has 2 share classes. So we have the share class B, that's going to be a 7% preferred rate of return, minimum investment of $50,000. And there is a smaller window to invest in that, which is open till about the middle of September here. And then we have the share class C, that's going to be a $30,000 minimum investment. That's a 5% preferred rate of return. And then we do an equity split on the fund of a 60-40, with the investors getting 60% of the proceeds after the preferred rate of return is covered, and People's Capital Group, my company, getting the other 40%. We do not charge an assets under management fee, an AUM, which you'll often see with real estate syndications. They'll charge a percentage of rent collected or funds raised. And we don't believe in really a fee-based structure. We're more of an equity-based structure. So we need to perform. We need to get our investors paid, first of all, on that preferred rate of return, which means they get paid first on the net profits of the building, the net cash flow, the net proceeds from the cash out refinance every 3 to 5 years. They get that preferred rate of return first, and on top of that, they get the equity split. So all in all, we'll target about a 10 to 12% annualized cash on cash return for our investors, the higher amount being the better share class. But historically, we just hit a 24% annualized cash on cash return to our investors on a property in Patterson. We hit about 16% before that. So we try to really underpromise and overdeliver. The market's obviously been very good, but the in-house infrastructure's been nice as well.
Cool. That's interesting about your structure. I'm often seeing, I know there's some people that will charge 50-50 on the equity. Most of the time, my group, they're used to seeing maybe 20-80, 70-30 in favor of investors. But there's the other fees associated with it. Sometimes there's an acquisition fee, or sometimes there's typically an asset management fee, property management fee. And so when you do 60-40 preferred rate of return, it's a little cleaner. I'd be interested to see how those line up between the two, but that's interesting. So
yeah, at the end of the day, the return on investment's pretty much the same as what other competitors are offering. It's a very competitive structure. We don't do the disposition fee. We own the management company, so we do a discounted property management fee. We'll do about 2/3 what your normal property management company will charge, and that really just hardly covers our costs. It's actually a loss leader for us. So, it's a discounted property management fee. But yep, that's another no disposition fee there, no AUM. So, it's at the end of the day, it's just a slightly different structure. I think a lot of investors like it because it is performance based. We need to cover that preferred rate of return hurdle to get paid ourselves. And obviously, the better we do, the more we put on our plate also. So it's really a nice win-win structure. It's not like we get paid a fee every month, every quarter, no matter what. We're just the human mind doesn't work as well when you're not incentivized to perform, and make sure you're that mark. My business partner Seth and I, we own the company 50-50. It's our cash as well, invested in the company and the properties and the projects. So you better bet we need to perform here. It's not like we're working for a family office or a hedge fund or something like that.
And the second part of the question that somebody had texted me is, do you mind telling us a failure story, maybe a deal that didn't perform, lost investors money, broke even, etc.? What happened, or has it ever happened?
Sure. Yeah. I mean, you do 250 transactions in real estate, they're not all going to work out. So, we did really well flipping lower end houses and mid-level houses, a lot of inner city properties. And we were like, wow, we're such good house flippers. Why don't we flip $1 million homes and we'll make millions of dollars? So we brought the same contractors out from the inner city areas into multi-million-dollar properties, started buying those for what we thought were good prices, and ended up the construction wasn't really done properly. We had to have it redone by better contractors, and the resale values weren't always on target. It was hard to nail down the resale value of homes over $1 million. They're kind of less in demand, and there's a much smaller buyer pool than a home you're selling for $300,000 or $400,000. So, what we found was it's actually really hard to flip multi-million-dollar properties. So we did lose some money on some of those projects, and we wrote a check to our investors at the closing table. They made a 12% annualized cash on cash return on their investment. We made sure they hit what we targeted on paper at the beginning of the project, because we screwed up. It was our fault. We hired the wrong people. We didn't hit the mark. So because of that, we took it on the chin, and we lost some money. And that was around 2015. And we said, you know what, no more flipping $1 million homes. In fact, why are we even flipping homes at all? Because let me tell you, if you do really good on a few, but you do really bad on a couple others, you broke even for the year. All right. So that was pretty much what we were looking at that year. And we were like, well, flipping houses isn't the tried and true strategy we thought it was after doing about 50 of them. And it's not scalable. See, if you want to scale up to 1,000 units, you can. That's a reasonable strategy. If you build your management company over time, you build your investor base, you treat your investors great, you overperform, people will continue to invest, and your management company can grow with the buildings. Flipping houses is like a million moving pieces. It's not the same experience every single time. Where generally with apartment buildings, you're talking about the technical term is lipstick on a pig. And, that's really a lot of the cosmetic type of renovations we're focusing on. We were doing ad levels. We were, the bureaucracy. I remember one town person said, well, I don't really like your like attitude or something. Like and I was like, I'm not going to approve you for the thing. And my architect like totally blew the presentation. And like they didn't like him, and that's why I didn't approve him for this addition we were putting on a property. And it was just straight politics and bureaucracy. And I probably hired the wrong architect too. But man, flipping houses is a really tough business. The hardest dollar I ever made was flipping houses. So we doubled down on syndicating real estate. We developed our management company to reposition apartment buildings. That was in 2015. And since we've done 9 syndications, we've got about a $20 million portfolio today. So we sold some properties as well. Oh, you're on mute, buddy.
Cool. Thank you for that. I have to talk really loud for you to hear me from here.
No problem.
And then somebody was asking, can you imagine a scenario would you not be bullish on multifamily?
Yeah, I mean, I don't know if I'm not bullish on multifamily. Yeah, the scenario where interest rates are 18%. I mean, that's a pretty crazy scenario, right? I mean, you got to think, okay, prices are going to come down or something's going on. Like you're definitely not paying what you're paying today for real estate. So, but in that scenario, most investment opportunities are going to be complete junk. I mean, what's the stock market doing, right? What's small businesses doing, right? So you have to look at that and say, okay, well, where do you go for shelter in these, terrible scenarios where there's 18% interest rate? Well, one thing people need to pay is their rent. Right? You might not pay, you might not go on vacation. You might not get that sports car, right? You might not buy a home, but you're going to pay your rent or you're going to get evicted. Right. So That's how it works. And there are private property rights, and as long as you own the real estate and you manage it the right way, you do collect your rent, even in a blue state. You know, you got to put your best foot forward with your tenants. You can't be a jerk of a landlord, but if you're nice to your tenants, you treat them with respect, and they lose their job and they can't pay their rent, you have an amicable exit generally. Say, okay, sorry, buddy, you know, let's pay your rent this month. If you move out next month, we'll give you your security deposit back, and you know, so on and whatnot. But so we do try to work out the amicable exits. But yeah, for the most part, yeah, if interest rates were 18%, like the market was terrible, I'd probably just kind of really be picky, super picky on what I'm doing, buy with cash, and probably build the largest amount of wealth growth I've ever experienced in that scenario. So, I mean, just if you think about the opportunities you could snag and then wait for the market to come back, you know, imagine you bought $10 million worth of real estate in the early 80s for cash when real estate was super down. And now, you know, what's it worth? $300 million, right? So,
Yeah.
that's it, right? So it would be an opportunity as well if you're really smart and prepared.
Yeah. Cool. I like it.
Yeah. Excellent. All right, Keith. So we're about at the top of the hour here. I think we had a pretty nice presentation. We covered a lot of topics, got some great questions from the guests as well. So here's what I'll do on my end. I'll put our website, peoplescapitalgroup.com, here up for people to check us out, and you can contact us there. I do a weekly podcast. I do a blog as well every week, and we have webinars pretty much every other week that we put out. So tons of content on our site. I don't sell the coaching or anything like that. We just focus on helping people invest in real estate. We've been doing this about 10 years. It's peoplescapitalgroup.com. I'll just punch it in here. Okay, so that's our website. You can find us there. And Keith, you want to put your information out there as well?
Sure. If anybody wants to reach out to me, has questions, I already know most of you, but if there's somebody new or you want to share it, a great way to learn about us is we've got something we've designed called the Wealth Builder Experience. And it's really for people who are looking to see what community at Financial Journey looks like, and just see the amazing people in this community. That's a way to kind of both learn, have a great takeaway, and see what that can look like. So perfect.
Great. And I also put a link up in the chat there for my Calendly. Sometimes that's definitely the best way to connect with me. So if you are interested in learning about the next deal we're buying, the 63 unit in Trenton and other buildings after that, learning about this fund we're doing, you can schedule a call with me right there. I just put the link in the chat. So perfect. That's the best way to learn about what we're doing. Get qualified as well. I operate a 506B, so I do have to talk to everyone before they invest in our fund. So the first step is scheduling that discovery call, and that's why I put the link there. So thanks for coming out. Really enjoyed the presentation tonight, Keith. I always enjoy talking with you. And I'm going to ask my boss, my wife here, if I can attend that event in November. See if that's on the agenda.
Sounds good. Talk soon. Thank you.
Thanks. Yeah.
Have a good night.